This is a special edition of MacroVoices with hedge fund manager Erik Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of MacroVoices, here's hedge fund manager Erik Townsend.
MacroVoices episode 181 was pre-recorded for release on August 22nd, 2019. I'm Erik Townsend. This episode of MacroVoices is brought to you by TopTradersUnplugged.com, the only podcast dedicated to quant and rules-based investing, which I highly recommend. We're deviating from our usual format this week in order to give our production staff a very well-deserved summer vacation. So there won't be any market wrap or postgame segment this week. Instead, we're dedicating the entire episode to the first half of a two-part summer special on the future of monetary policy. This subject was inspired by the many listener requests that we've received for more content similar to the U.S. dollar endgame series that we ran over the 2017 Christmas holiday. For any new listeners who may have missed that super popular series, which is still as relevant today as the day it was recorded, it's still available free of charge on our homepage at MacroVoices.com. Just click the Timeless Series button on the black menu bar at the top of the homepage. For this year's summer special, we're going to take a deep dive into monetary policy. Not just where we've been, but where we're headed. We've got two fantastic guests lined up. Peter Boockvar is a well-known analyst and frequent guest on CNBC. He's the Chief Investment Officer for Bleakley Advisory Group and the author of the popular Book Report blog. Danielle DiMartino-Booth is a former Dallas Federal Reserve advisor whose book, Fed Up, was a bestseller. Danielle thinks that we're headed for negative interest rates in the United States, but Peter thinks that outcome is extremely unlikely. They disagree on quite a few other points as well, and that will make for an interesting exchange. I'll be joining Peter and Danielle as one of the panelists for this series, and Patrick Ceresna will be the overall moderator and MC. This week, we're airing Part 1 of this two-part series. Part 2 will air next week on August 29th. We'll return to our normal show format starting on September 5th, when we'll have a market wrap feature interview and postgame segment as per normal. This temporary show format created something of a conundrum for us because our sponsor had already paid for a mid-roll advertisement which would normally air between the market wrap and feature interview. We thought the only option was going to be to break up the interview and put an ad in the middle of it. But when our sponsor, Niels Kastrup-Larsen over at TopTradersUnplugged.com, got wind of it, he said, "No way." Neil said, "Look, I'm a podcaster myself, and the last thing that we should do here is to piss off the whole audience by cutting Danielle and Peter off in mid-sentence just for an ad." He said, "Look, just put my sponsor message wherever you can fit it, and let's give the audience what they want." So I'm going to bring you the message from Top Traders Unplugged now and get it out of the way before we dive into this fantastic interview. This episode of MacroVoices was made possible by TopTradersUnplugged.com. You often hear me say that even if I have a conviction about a market or a trade, that you have to listen to what the market is telling you, not what you think it should be doing. And that's exactly what trend-following managers have been doing for decades with great success. These are rules-based strategies that remove human emotions and therefore can be well-researched and tested. And there's one podcast that covers trend-following strategies better than any other. TopTradersUnplugged.com. And right now, MacroVoices listeners can even get a free book called The Many Flavors of Trend Following, explaining exactly how these systematic strategies can work for you. Just go to TopTradersUnplugged.com/macro to claim your free copy. Again, that's TopTradersUnplugged.com/macro. Check them out. You'll be glad you did. I really want to thank Niels at Top Traders Unplugged for caring more about keeping MacroVoices focused on you, our listeners, rather than getting the best possible ad placement. So without further ado, here's part 1 of our summer special with no commercial interruptions.
And now, with this week's special guest, here are your hosts, Erik Townsend and Patrick Ceresna.
So I want to start this conversation with the FOMC statement and the rate cut that occurred. And Danielle, you were on our show on the All Stars episode before the FOMC meeting, and you talked about this as a historic rate cut and that potentially it was the onset of a potential new currency war, which you completely nailed. It was a great call that you made. But now that this is now rearview mirror, what's your impression on the reactions after the FOMC and what are we looking at here going into the September meetings?
Well, I think we have to keep in mind what all currency wars entail, and the fact that there are not just two players here. This is not isolated to China and the United States. No matter what happens between the two countries, whether it's South Korea you're talking about, whose stock market has suffered tremendously this year, or the events that have been underway in Hong Kong for some time, or China's or the United States' other trading partners, whether it's the Japanese or the Germans. None of these volleys in this war occur in isolation. And as much as even the most dovish members of the Federal Open Market Committee would like to present otherwise, to convey that unified front, there is nothing that the Fed can do or say to contain a trade war if the real economic damage, the collateral damage, becomes to where it seeps onto our shores in the form of an increased recession probability, which is exactly what the yield curve has been communicating since that first rate cut that they said and hoped would be a quote unquote one and done.
So, Peter, how does your opinion differ from that, or do you have a different view of what happened here at that FOMC?
No, I feel the same way, and in engaging in the effectiveness of what the Fed is trying to do is, we have to understand the basic function of what the Fed or other central banks do is when they cut rates, they're encouraging you to borrow money. They're encouraging if you're a household or you're a business. So when you stimulate from a monetary or fiscal standpoint, you try to convince people to do something today that they may have waited till tomorrow because they were saving money, and you convince them to try to borrow. Well, with borrowing costs so low right now across the world, as we know, particularly in the U.S. where the Fed's trying to stimulate, there's nothing really to stimulate. So that's when you get into this Japanese malaise where low rates forever stops being a stimulant because you're not convincing people to do things today. They're just waiting until tomorrow. And the same thing is happening in Europe, and the same thing is going to happen here. So what the tools that the Fed has really is irrelevant at this point. So to Danielle's point, when you get this sort of slowdown that's global right now and industrial/manufacturing center, at least for now, because of the tariffs that is now spilling over into other areas, this is going to play itself out. And what's going to differentiate this downturn, and whenever the recovery after the downturns takes place, is that relying on central banks to create some sort of V-bottom recovery is just not going to happen this time. There's going to be a lot of bouncing along the bottom. There's going to be a lot of churning in the economy for more time than people are accustomed to. If you look at the behavior in the stock market, the stock market still believes in this V-type recovery, and that the Fed can sort of create magic, and Powell can change his mind in January, and everything's going to be fine, and we can compete in multiples that earnings will eventually substantiate, and everything's going to be fine. And I think we're going to realize that pushing on a strain, which has been around forever, is going to be a term that's going to be used a lot more over the next 1 to 2 years.
Now, Danielle, I wanted to circle back to your call that this was potentially the start of a new currency war. And clearly you nailed it, because no sooner did the rate cut occur did we have the dollar strengthen and Trump get out there and immediately escalate tensions between China. So why were you on top of this? Like, what did you see coming? And is this playing out according to the way that you envisioned it when you were on the All Stars episode?
Well, I don't think that anybody in America or basically on planet Earth can envision what our president is going to do next. if they tell you that they can, they're lying. But I did know that the 25 basis point rate cut would not be to the satisfaction of the White House. That much anybody could have said in advance. So his reaction, Trump's saying that he was going to impose the 10% tariffs as of the beginning of September across a much broader spectrum of Chinese goods, was certainly something that could have been anticipated in order for him to get the reaction that he wanted, which was a full pricing in of the 25 basis points he didn't get at the July FOMC meeting. Now that occurred, and in that sense, Trump was perfectly successful. Where the backfire comes in, as we watched retail stocks melt down in the following days because there are so many companies in the country that simply can't withstand another body blow to their margins when they're already operating at such razor thin levels. What nobody anticipated, myself included, was that after over a decade, that Chinese authorities would allow the yuan to trade through the 7 level as retaliation against what Trump had done. The reason I'm bringing this up is because Trump tends to throw things out there and then pull them back once he gets the result that he wanted. Well, if the result that he wanted was simply the market fully pricing in a September the 18th rate cut by the FOMC, then he might have taken back the tariffs, knowing that it might not be such a good idea to try and forcefully put JCPenney, Macy's, and Gap out of business before the holiday season hits. I mean, I'm just throwing names out there. But because of what the Chinese did, because of their response, and because of the Treasury Department's naming China a currency manipulator in further retaliation, this means that nothing can be taken back. So Trump thinks he might have taken a baby move to push market pricing to where he wanted it to be, to get the easing out of the Fed that he felt Jay Powell did not deliver on. And look what happened. That is the nature of a currency war and why it's different than simply President Trump tweeting something out saying, I'm not satisfied with the amount of love that I'm getting out of the Eccles building.
So, Peter, what's your impression of where Danielle was going with that?
She's spot on in that it's gone to another level. We can even take a step back and say, you know what, this currency war actually started back in 2012 into 2013 when Abenomics came into being, where the yen was around 75 to the dollar. And one of the purposes of Kuroda doing what he did was to weaken the currency to try to import inflation. So their currency weakened from 70-ish to 120. And then you go over to Europe, and Draghi's intent when the euro is at 140 was to get it as low as possible and import inflation to get to their levels of 2%. Well, we've seen a decline in the euro, of course, from 140 to 110-ish. We've seen the weakness in the yen, and neither central bank has been able to generate the inflation that they want. I think that's a good thing that they were unsuccessful, because the last thing those two regions needed was higher inflation. But the point is that they dramatically weaken their currencies, and Trump sees what they've done. And he's feeling, well, I'm here defending, middle America and the manufacturing base of this country, and we have all these central banks pissing on their currencies, and they get the benefit and we don't, even though Japan and Germany, these are export-reliant economies that really gained no benefit from the weakness in their currencies. So it really became the thing to do, is depreciate your currency. And the Fed kept interest rates at 0 for 7 years. So the war has really been going on for years. But to Danielle's point, now it's just taken a whole new level. China is now gotten so in the middle of it as the second biggest economy.
All right. Well, Erik, what's your take on the currency war and this idea of what happened with the FOMC and the rate cut we just had?
Well, I really want to credit Danielle, first of all, for calling it a currency war and describing this FOMC meeting before it happened as the first shot at a new currency war, because that's really what I think it is. And frankly, where I think the world has been stuck for the last several years is we know a currency war is coming, but we're not quite ready to get into competitive devaluation yet, because everybody knows that it's not really good for anybody in the end. And, it's sort of like nuclear mutual assured destruction. We're all smart enough not to get into it, but once you do get into it, everybody piles in at once. And I think we've been waiting for years for that moment where we really go into this rhetoric war turns into a shooting war, except the shooting is not real shooting. It's shooting in monetary policy through competitive devaluation. And I think that's now begun. And I think Danielle called it on MacroVoices before it happened. So I really credit her for that. The thing that I'm perplexed by out of this whole thing is this language about the mid-cycle adjustment. I mean, and I think Danielle may have said this on the show too. So if this policy process started in 2009 and it's 2019, that's 10 years in. So if that's mid-cycle is 10 years, does that mean this is a 20-year cycle? What the heck is going on? And I don't know about you guys, but I never saw that one coming, that Powell would say, I just want to be clear, we're not starting a rate cutting program here. This is not a rate cutting cycle. We're just playing around here in the middle of a different cycle. That seems to me like an incredibly self-defeating act. And I would have thought that based on the market reaction to it, that he would have done the usual politician thing and said, oh, you guys misunderstood me. That's not really what I meant to say. Let me now say something completely opposite, and you just misunderstood. No, he's really went out of his way to stick to his guns and say, this is really what I meant. Do you guys have any insight on what is driving him? I mean, Danielle, you've worked in the Fed. Why would he do that?
Well, so I think that there are several things going on here because Powell has continued to not get his way. I'm not trying to characterize him as a petulant child, but this is definitely the man who wanted quantitative tightening to go on in the background on autopilot. This is the man who wanted to get the Fed funds rate to 3%. And this is the man who wanted to rally his troops and come together and make sure that everybody, all the way to Bullard, his most dovish committee member, was unified that this would be a one and done. So I think him coming up with a clever little characterization of it being a mid-cycle rate cut was a way of conveying and cementing, driving through his point that this was going to be it. Of course, the minute the market heard those words, it proceeded to completely throw up, and the reaction was violent. But I'll take a step back because a few press conferences ago, Powell was asked about whether or not he had, killed the business cycle, which he's implying that he has if we're going to have a 20-year business cycle, which is ridiculous. But a few press conferences ago when he was asked about it, Powell actually looked happy for the first time in a long time. He got a little glitter in his eye. And, he was speaking lovingly of the Australian episode of a near 30-year expansion. Well, guess what? That was reliant upon a very quiet currency war, to your point, Erik, that's been going on forever because back in the 90s, obviously, China was manipulating its currency. It is not today. But Australia was a huge beneficiary for decades, plural. And yet we've now seen, and Peter can jump in here because he's been a fan of Australia's discipline for forever now. But we've now seen Australia's 10-year sovereign yield sadly trade through the 1% floor to the downside. I'm sure Peter was watching the same thing as it happened recently.
Yeah, the Reserve Bank of Australia never really believed in negative real interest rates. And you had much tighter or smaller standard deviation, you can say, of monetary policy over many years, therefore reducing the odds of having booms and busts. Now, ironically, they've had a boom in their real estate market that is leaking air, but that's a separate conversation. But to the point of negative interest rates or negative real interest rates, start there, creates a whole different dynamic compared to positive real interest rates.
So, Erik, do you have anything to add to that?
You know, what came to mind as both Danielle and Peter were speaking was Dr. Pippa Malmgren's comments, and this was relative to President Trump and the China negotiations. But I think the same principle probably carries over to monetary policy and what the Fed is doing. And what she described is kind of an attitude of U.S. complacency, where I think President Trump is of the mindset that, you know, he's Mr. Art of the Deal. He's going to squeeze the Chinese government as hard as he can, you know, to get the very best, to get them to the point where, you know, they're really just hurting for a deal. And finally, when it's convenient and fits into his election schedule, he's going to say, okay, I'm ready now. I'm willing to go ahead and cut a deal with you guys. And what Pippa said, and what I strongly agree with, is, hey, don't assume that the rest of the world shares this U.S. view that the U.S. is in charge of everything. China might just say, no thanks, we're not playing your game anymore. You've been incredibly difficult to deal with. You had your chance. We're not going to deal with you. Now, I think China does want the deal, but I don't think they're going to kowtow to the U.S. as much as the U.S. is assuming. And I think the same thing carries over to central banking. So many people in U.S. markets, U.S. financial commentators, seem to be talking about how the Fed is going to do this and that and the other thing, as if the Fed were in a position to dictate to other central banks. Okay, here's the game plan. We're in charge. Here's what we want you to do, BOJ and ECB. Here's what we want you to do. And, you know, we're the Fed, we're in charge. I don't think it works that way. I think the ECB and the BOJ are going to do their own thing, and I think they're going to see this as a competition. And I think it could get really, really interesting. I think we're in very historic times. I'm very curious to get Danielle and Peter's reactions as to whether they'd agree.
Well, look, dictating is it's a difficult thing to do, even if you are the Federal Reserve of America. And don't get me wrong, I believe that central bankers are in the habit of and regularly coordinate policy. And there was I don't think Powell was in the least surprised when at its July meeting, the European Central Bank indicated that it would be easing policy on September the 12th when the ECB next meets. And I don't think that the Bank of Japan's comments have in any way, shape, or form not been coordinated with the Federal Reserve. But it's amusing to me at best when you see the wheels come off in one day's trading, and when you see credit volatility go through the roof and the yield on the 10-year U.S. risk-free rate, the benchmark for the entire world, crash. And that's not an exaggeration, pushing the inversion of the yield curve to its most acute, when all of the best laid plans among central banks was to do this cute little 1/4 percentage point rate cut that would elegantly uninvert the curve, and then they could get together and put their translating headphones on that they borrow from the UN and sing Kumbaya. It doesn't work like that, and I'm sure Peter would agree with that.
Yeah, I mean, essentially, the Fed's winging it, and they've been winging policy for a while. So for all the PhDs that they have there and all the models that these PhDs create, there is a sense of winging it. And I think Powell and others realize that because they stopped raising rates at the 2.25, 2.5 level, and Danielle said earlier they wanted to get to 3, they realized they only had 9 rates to cut, assuming that they would eventually want to go back to 0 again, which is a separate conversation. So when you have 9 rates to cut, you have to be very judicious with those 9 cuts. And I think Powell also is feeling an extraordinary amount of pressure from Trump. And you can have Fed heads write articles, or we're independent, we block out the noise, this and that. But there's still an extraordinary amount of pressure that he is responding to. Not that he cut rates because of Trump, but he still sees the weakness overseas. He sees the weakness in manufacturing, and he's saying to himself, okay, you know what, I can cut rates here, and then we can sort of stem that weakness and sort of create a firewall before it spills over into the consumer and side of the economy, and everything will be fine. And I think that's how he viewed this. In his mind, if this is quote unquote due to global developments, which is outside of his purview and outside of his influence because of the trade and manufacturing nature of the tariff-induced slowdown, he's hoping if I can cut here and then maybe we can get a trade deal and everything will end up being okay, then he can somehow skirt by this. But then, of course, he's getting dragged in every direction by what other central banks are doing. And the key question from here is, and Danielle's heard me say this, is does he get caught in this peer pressure vortex of going down the same path as the other central banks in order to keep up and satisfy what their models say, which is very simply rate cuts good, rate hikes not good, is where does he stop? So to me, it's not a question of, okay, is he going to cut here, is he going to cut there, but where's the end game for Powell at some point? Let's just take this further over the next 6 to 12 months, that the economy slows down, that services start to weaken, and we begin to see layoffs, and consumer spending gets hurt, and the stock market falls. Where does Powell take this? Well, in speeches, he said, yeah, it's not a question of if we go back to zero, it's when. And then he talked about it, I don't know if it was a Fed press conference or a speech, yeah, there are plenty of treasuries out there for us to buy. So he's told us that, yeah, he's going to go down the road of the BOJ and the ECB, but he's going to also learn the hard lesson that it doesn't work and it's not going to help, and you potential damaging your banking system, and you have the situation where the stock market's going to continue to rely on your rate cuts, but then when they finally realize that it's actually not helping spur faster economic growth, you're going to be back to that pushing on a string, and then central banks are going to have nothing. But the Fed has an opportunity to learn the lessons of what other central banks have done. And the question from here is, are they going to learn those lessons? Because the odds of a soft landing are slim. Historically, they've been slim. They've only been achieved about 20% of the time. And I would say the odds of a soft landing this time are much less. And is a central banker with the president tweeting and breathing down your neck willing to vulgarize the Fed and say, you know what, our rate cuts aren't going to do any help, and it's just going to get us trapped like other central bankers are going to do, or is he just going to fall for the same trap that the others have?
All right, so moving on, I wanted to go back to that statement of a mid-cycle adjustment, because assuming it's a mid-cycle adjustment, then all of the economic slowness we have here should be very moderate, and we should see everything start to pick up on the other side. Yet we're seeing a potential global manufacturing recession starting, and potential earnings recession starting. Everything is starting to weaken. In your minds, is this just a modest slowdown that will recover, or is this something that can morph into a much bigger economic recession? What's your take, Danielle?
Well, I think that if we don't fall into recession, that I'll have to, excuse the pun, I will have to trump out that phrase, it's different this time. And, I'm remiss to do that. What I would point to, though, is the very slow degradation that we have seen in the creation of high-paying jobs. And this is something that peaked out last fall, and it has slowly but surely been coming down on a monthly basis to where the bulk of the job creation that we're experiencing now is in what we call low-paying jobs, eat, drink, get sick categories. And that's not going to help propel the economy forward. One of the data sets that we pay close attention to that I've spoken to before is the Challenger Gray and Christmas data. What started out with Challenger and Gray was basically a retail story that made everybody's eyeballs roll to the back of their head. But what we noticed getting into 2019 was that we were starting to see not just automobile and industrial layoffs kick in a big way, but we started to see that of information technology and transportation, and more recently, even financials. And we're seeing a lot of the big banks announce layoffs. So if you see the movement from the, we can ignore the 11% of the U.S. economy that is manufacturing. If you see seepage into the services sector, which is exactly what we're seeing, we've had 8 or 9 trucking companies go bankrupt so far this year. That is a services sector that happens to have led the entire economy in 2018. That was one of the recipients of all the panic buying ahead of the potential increase in Chinese tariffs. When you start to see the bleed from industrials into that 88% of the U.S. economy that is services, then you know that barring some kind of fiscal stimulus measure, Because I think, as Peter said several times, it's increasingly apparent that the Fed is pushing on a string. If we don't get something from Washington, I couldn't throw the probability out there of getting an infrastructure bill, say, before the election, ... not. If we don't get something of that ilk, I can't see a pathway for the economy not continuing its slow slide into recession.
Right. And Peter, where do you stand on that view?
So I think what will be the determining factor of whether this is going to be just a normal recession, when I say normal, somewhat being mild without any crazy exogenous effects, or to something that will be deeper, where do asset prices go? Because if you look at the consumer right now is the strongest part of the economy, but of course showing vulnerability if services weaken and we start to see a slowdown in hiring. We saw a slowdown in hours worked in the last payroll number. If all of a sudden the stock market stops getting the benefit of, oh, the Fed is going to save me, and actually starts to really correct, not just have your V bottom that we've seen countless times over the past 10 years, but a sell-off in the stock market that lasts, a sell-off in real estate prices that last, a widening of credit spreads that starts to impact the financing of small, medium-sized businesses. That's where you go from a mild recession to something deeper. We have to remember the last two economic recessions were really exaggerated by decline in asset prices. The decline in tech stocks led to a collapse in CapEx, and obviously the decline in house prices led to a collapse in bank balance sheets, and then it went from there. So to me, we have still this asset price dependent economy that affects not only the psychology of its participants, but also the financing of the Beyond Meats and other venture capital business. So where that goes in response to this economic slowdown, I think is going to be a really important determinant in measuring the extent and the deepening of any downturn.
Right. Erik, do you have anything to add to that?
My perspective is a little bit different because what I think about the most is, first of all, a recession has to be coming because you can't go forever without having one. It's been 10 years. We're overdue. It's beyond my pay grade to say whether that happens right now or not, next quarter or the quarter after that. I'll be very, very surprised if we got to the end of 2020 and there had been no significant recession. I think it's much more likely that one has already begun and we don't realize it yet. But I don't claim to be able to time these things. That's past my pay grade. What I think is much more interesting to think about is, will the next recession be the catalyst that triggers what Ray Dalio calls a paradigm shift? And for anyone who's not familiar with Dalio's writings on the subject, what Ray has predicted is, he said, look, we're in a paradigm in markets now where central bank liquidity has been holding up asset prices, and it's been working. And that cannot go on forever. It will stop working. There will be a loss of confidence in the system, and it will eventually reverse to the point where central banks are completely unable to support asset prices with printed money. And at that point, the whole name of the game changes. And even Dalio, who's one of the most respected money managers in the world, said it's beyond his pay grade to know when that's going to happen, but he's convinced it's coming in the next few years. And the big question in my mind for the next recession is, will that recession be the trigger that sets off that paradigm shift that Dalio is talking about, so we get into a regime where suddenly central banks are no longer able to support asset prices by conjuring money out of thin air the way they have been for the last 10 years? And I don't know the answer, but to me, that's the most important thing to watch for as we get into the recession, which I'm confident is coming probably within the next year.
Well, we've reached that point overseas. I mean, the Nikkei is down almost 50% from its peak. The Topix Bank Stock Index is down 90% from where it was 30 years ago. The Eurostock 600 is below where it was in 2007, and their bank stock index is down 80% from where it was in 2007. So outside of the credit markets, those central banks have already lost control of their equity market. Not that they have the same reliance on stock prices that we do here, but it's proven there to not have worked. And at some point, to your point, and what I believe will be eventually here, is the Fed will lose control of our stock market, which will then determine how deep that recession gets.
And that's where you want to own gold, and a lot of it.
Correct.
I think right now this conversation can take a turn towards the societal implications of, which is I think what you were starting to get at, Erik, kind of the societal implications of Fed policy and what it has produced and where there might be resistance in the coming years, given some of the comments that Dalio and people like Stanley Druckenmiller have made recently.
Danielle, you hit the nail on the head. I think that's exactly the place to go next. And one of my predictions is it's not just how central bank policy will affect the social mood, but it's also how the social mood will constrain the ability of the Fed to act. And one of the things that I predict is that when we get to the next significant market crisis, and the Fed really does have your back, the Greenspan put is still there. Central bankers do intend to save markets. And then suddenly there's a 10 times bigger than Occupy Wall Street uprising of the people that says, hell no, no more bailouts for Wall Street. Let the stock market crash. We're sick of bailing out the bankers. If you're going to print money out of thin air, give it to us. Use it for universal basic income. Use it for forgiveness of student loans. Use it for whatever other social spending program. And I think that there is a rapidly growing support for that. So I don't think it's just the central bank policy affecting society. I think it's society potentially at some point tying the hands of central bankers in their ability to rescue markets.
And Erik, I agree with that. If you listen to some of the Democratic debates that we've seen, a few times I've heard people talking about, well, yeah, the stock market's up, but not everyone owns stocks. And I think that the politics around more QE and going back to zero to lift asset prices are going to be a lot more difficult from the Fed, from the Democratic side, than they've ever experienced before.
I completely agree. Danielle, what's your take?
Well, so I have some very deep thoughts and feelings that have been triggered by a recent interview that Stanley Druckenmiller gave to CNBC, in which he said that Fed policy has been fantastic for rich people, and that, quote, unquote, this is the biggest redistribution of wealth from the middle class and the poor to the rich ever. I don't think that he's only speaking for his billionaire buddies, but I think rather he's speaking for the 99% who are quite certain they've been left behind. And the governor that I see on Fed policy that has not been as much of an inhibitant, if you will, to the European Central Bank, to the Bank of Japan, to the People's Bank of China. The biggest governor I see going forward is that because there's so little ammunition, to Peter's point, we started out with 9 bullets in the chamber, not a lot compared to prior cycles when we've had over 5 percentage points of ammunition. But what happens if, let's just say, the Fed gets to the point of needing to launch quantitative easing or feeling that it needs to launch quantitative easing? We know it doesn't work, so why go there? But what happens if they get to the point, if the Trump tweets, Trump's already started tweeting about quantitative easing, the volume's just going to get higher and higher. But can you possibly see in this world of rising populism and this feeling that we don't need to bail out Wall Street, but we need to bail out Main Street? Can you imagine what happens the next time the Fed announces quantitative easing? It just doesn't want to go there. I think they will have the wrath of Congress descend upon them almost immediately, demanding that the proceeds of the Fed's printing press not buy treasuries that benefit the bank and the banking system, but rather that they fire up the printing press to pay for X, Y, and Z for the little guy who was left behind during the decade of unconventional monetary policy that clearly only benefited the fat cats on Wall Street. That's going to become extremely problematic, even for the crowd that is clamoring for the Fed to print money for social relief, because of the effect such criticism and such skepticism would put, the effect that this would simply have on the stock market and on the credit markets. And these are the dots I don't think people are connecting. Erik, Peter, I'd love for both of you to tell me how you think risky assets would react if QE was announced, but it wasn't going into treasuries.
Oh, I think it's coming. I think actually QE will be announced into treasuries and it will not actually be implemented because before they have a chance to click the button, they're going to have a revolt from the political left. And the political left is going to say, look, you need to use any printed money for the things that we want to use it for, which is social spending and universal basic income and so forth. And what's going to happen is the policymakers at the Fed and the political right are both going to respond and say, wait a minute. You guys don't understand this stuff as well as you think you do. See, we're smarter than you, and we know that the way you want to do it would be like really inflationary, and the way we want to do it is not so inflationary, and you should trust us because we know better than you. And the political left, which is going to have the majority behind them, and frankly, I think they should. It's not my personal political belief, but I think they would make a very good point, which is, hey, guys, we've tried the business of trusting the political right and their politicians on what the policy should be. We've seen how that went. No thanks. We're not interested in that. We want to do it our way now, and I think that the popular response that they would get would be unstoppable. Regardless of whether policymakers want to do it or not, they would be forced to do it. And I think that we're very likely headed to some incredibly inflationary and frankly reckless policy decisions ahead of us, not because the policymakers want to make those decisions, but because they won't be given a choice. The political pressure will be so strong that there will be no possible way to oppose it. That's my take.
So then, Peter, I'll put you on the spot here. Let's just say Eric's scenario plays out. How do you think the frothy leverage loan, junk bond, investment grade bond, stock market, how do you think risky assets would respond?
Well, it'll be a problem because if Erik is right, and then it does lead to higher inflation. Because when you look at QE is just essentially an asset swap. But if QE is going to be used not to buy treasuries, but to basically hand money out to people, the inflation implications then have a direct influence on where bond yields go. Bond yields will then rise and then squeeze, every company that's too leveraged because you're going to have a stagflationary type environment with shrinking cash flows and higher inflation and rising interest rates. And that's like nightmare scenario.
I'm not able to kind of poke either of you into giving me the answer I want, though. But everything you said, Peter, and everything you said, Erik, all makes sense. But what happens if the beneficiaries of the Fed's next round of QE, what happens if the beneficiaries are not the markets? And the markets fall out of bed, and you have everything that Peter described with inflation and rising interest rates, but at the same time, layoffs and unemployment go through the roof.
Danielle, I think you get ultimately an inflationary depression. At least that's the potential risk. And the way that would come about is we have dual bubbles in both the stock market and the bond market. And everybody assumes that they can't both burst at the same time. But if you suddenly had the realization in the marketplace that, hey, the Fed does not have our back anymore, they can't, they've been politically outvoted, and all of a sudden they're not buying treasuries, you've got a potential to set off a trigger for higher bond yields, not just for the reasons that Peter just described, which were all excellent, but also because there's effectively a bursting of the bond market bubble with a coincident burst of the stock market bubble. That in turn forces a systematic unwind of the massive institutional risk parity trade, because all of a sudden that correlation ratio that trade is based on stops working. And you have a massive meltdown along with much higher bond yields, runaway inflation. And the thing about all this is, inflation has a lag effect. At first, it will appear that the policies are working beautifully. The handouts are very popular. People love having the money. The inflation doesn't start on day one. It seems like everything's great. There's a jump for joy and a celebration, and let's do even more of it. Eventually, when the inflation catches up with the economy, and you have out-of-control bond yields, and suddenly the U.S. government cannot service its own debt, even applying 100% of tax revenues to servicing its debt, you have to raise taxes in order to service the debt, and you can't because you're facing a stagflationary environment where nobody can afford more taxes. You've got an absolute crisis on your hand. And I think that we have all the ingredients, certainly not that those things all happen overnight, but we have the ingredients for a social spending program where QE is used, as Peter described it, for handouts. And it works beautifully at first. It seems like it's working. They do even more of it. And eventually you get to a point of no return where there's this snowball effect and you can't stop it at that point. And that's what I'm afraid is perhaps the worst case that we may be headed to in the next decade, certainly not in the next year or two.
Erik, I think there is a solution for that. At least it's been proposed, and that's MMT. So I'd love to move on to this topic and get everyone's opinions about modern monetary theory. So let's start off with you, Peter. And what's your impression? Is this something that's in our future?
Well, I feel like we've sort of been living it right now in lower doses compared to what some proponents of it talk about. But certainly in Japan, you can argue that we've been living it for years, and we can see clearly what the results are. In Europe, you can argue, and in some way here. So you take it one step further, and to the point of whether it can be contained in the sense that there are no side effects. Well, that assumes that there's unlimited supply of things, that where MMT is a demand driver of things. But once you get in a situation where people realize that excess demand created by MMT, where money is just handed out to people, meets a fixed amount of supply or more limited supply, then you get into a dangerous inflation situation, and everything unfolds the way that Erik just talked about. And the bond market revolts and sort of takes away this printing press and takes away this option of a government. When you think about all this easing that we've done, it's, okay, you originally have easing, it doesn't work. And then the government response is, let's do more easing. That doesn't work. So MMT is then the next sort of doubling down and send in more, because all the monetary stuff on its own didn't work. So let's combine that with a fiscal push, and then we'll really get to what we want. But that will fail as well. And getting back again, what will eventually call it out and eventually end all this on market revolting to the inevitable inflation that MMT creates.
Right. And Danielle, what's your thinking on MMT?
Well, I think MMT is, not to make any enemies here, but I find MMT to be amusing to the core, namely because when inflation rears its ugly head, and presumably in a situation in which MMT in the United States was being pursued, it would be running, to Peter's point, in hyperdrive in other countries. So there's this assumption that as long as you've got a printing press and you're issuing debt in your own denominated currency, thank you, Christine Lagarde, isn't she coming on at the right time? Eurobonds. But there's this idea that all of the countries with printing presses, China included, can carry on with their own MMTs in isolation, until which point you reach a debt to GDP level that triggers inflation. And here's the amusement factor. Once this inflation is triggered, you simply fix it by levying higher taxes on those who can pay. Now, I think we're still talking about a United States of America with a Congress, and the need for Congress people, when inflation is going haywire, to come in with tax hikes. I don't see the political will or wherewithal to resolve the challenges that MMT will present via rising inflation by increasing people's taxes, kicking them while they're down, if you will. You'll have billionaires simply get up and leave the country, and millionaires, if that level of socialism was to be imposed, along with what we spoke of earlier. What would be required of having the Fed be the conduit to print the money, to solve all of society's woes. And something else that would come into play here, and this is a huge debate that I recently launched on Twitter, is, well, let's just say theoretically that Wall Street is not bailed out, and therefore the stock market and the bond market fall out of bed, and that might or might not take down a few states such as, New Jersey, Illinois. With it, the pension systems fail. Can MMT therefore just be deployed to make sure that we don't have pensioners with no pensions? Can MMT theoretically just be used for whatever ails the economy? Fill in the blank. And the answer was, of course, this is via Twitter, and I'm poking bears on purpose at this point. But the answer was, you have a fundamental misunderstanding of what MMT is. MMT prints money in order to raise people up together. To which I replied, well, what happens to those who are falling down because of it? So at which point we kind of came to a stalemate, and I pretended to be stupid and moved on.
Erik, do you have anything to add to the MMT storyline there?
I'll just build on what Danielle said at the end there. And my view on MMT is it is one of those very interesting things where I do not think it is possible for any person, and I include myself in this criticism, to separate their own political ideology from their opinion about MMT. You take a guy like Professor Steve Keen, whose whole story is entirely about there's too much debt, and debt is the enemy, and we've got too much debt. But Steve describes himself, these are his words, not mine, as being politically just left of Nancy Pelosi. And despite being a total anti-debt guy, Steve is a big proponent of MMT. He thinks it has a lot of value. I will be the first to admit my own anti-MMT perspective is based on what are admittedly political beliefs. I don't think that you're doing anyone any favor by giving them free handouts. I don't think that it is beneficial to society for there to be free college tuition. I don't think that's a good thing. So I'm against MMT. But Patrick, I admit that my political ideology is influencing my opinion. And I don't think anybody has an unbiased opinion on MMT. Everyone is biased by their own political philosophy. And I think it affects the way that people think about this. And it's scary because MMT is going to be a really, really big deal. And I think all of the people that, and this is probably a criticism that applies to the way most of our political policy making occurs, all of the people involved in the decision making are going to be making emotional decisions based on their own philosophy, as opposed to really looking at the hard facts of what works and what doesn't work, and what the cause and effect of various policy tools are in the economy.
So, Erik, if I could jump in, I'm going to challenge you for just a minute. I think that if you look at the Scandinavian example of pockets of MMT already having been deployed and see that the people who are on the receiving end of MMT type policies are decidedly happier, but at the same time, the employment situation is not improved in the least. I think you can look at MMT agnostically and apolitically and determine that if it's not going to generate a longer term, higher economic growth trajectory, that in and of itself, it should be abandoned. Because the MMT philosophy is that this will raise all boats by making people happier and therefore more willing and able to succeed and provide their own, whatever it may be, economic input into the longer lasting, better growth rate for the country, which some MMT experiments are already proving not to be the case. That's pure economics.
Well, Danielle, my hat is off to you. If you are able to be completely agnostic about MMT, then I think you are in a very small minority. And my opinion is most of the people who claim to be agnostic really aren't. They have beliefs about what is socially appropriate, what we should be trying to accomplish socially. And I think that most people's opinions are biased by that. And I certainly admit my own opinions about MMT are biased by that. If you're able to be so intellectually disciplined as to stay completely agnostic and not allow your own political philosophy to enter the equation, my hat's off to you. I wish I had the same ability.
And also it gets to, do you believe in the effectiveness of the actual implementation? Because somebody has to implement this. Someone has to make the allocation decisions about where this money goes. And getting to your point, Erik, about the politics and what people think, yeah, you have more of a tendency to believe in it if, for those people, those of a political ilk that believe in the capabilities of the government, those that question the efficiency of government, generally speaking, are obviously going to be more suspect of this policy, particularly on the implementation phase.
Right. And yes. And Peter, to your point, if you can imagine just one itty bitty example of MMT, which is obviously a large one, is Medicare for all, there's an underlying assumption that the federal government can be an efficient arbiter of healthcare in America. I don't know of an efficiently run American agency in existence.
Right, and getting to my point earlier about, okay, we're going to create all this demand for things through MMT, but no one's talking about what the supply is. I mean, let's try to figure out how many doctors are there going to be left if we have Medicare for all, and that a procedure for an hour is going to cost $26. Doctors are going to be falling out of the system by the wayside. Hospitals are going to go out of business. So in that debate, no one talks about what's the supply response going to be when all the money is then thrown on the demand side.
That's exactly right. In fact, we've already seen a taste of that with what has come across just with Obamacare. I mean, I personally have lost 3 doctors who've gone off to become concierge services because they simply couldn't make enough of a profit given malpractice insurance costs to make it worth it.
Danielle, I'm just going to come out and say it. I think that in many ways your comments are actually revealing my point, which is if I listen to you and Peter talk about this, it's clear that your philosophy, you just said you've never seen a successfully managed government organization. You have a set of beliefs about the value of government. And I'm sure if we had an MMT proponent here, they would have a different view. They would think that government is capable of doing all sorts of wonderful things, and people like you just need to get out of the way, and government can do all sorts of fantastic things for everybody. Your political philosophy and your, as Peter put it, your inclination to believe that government is the solution to a lot of problems strongly affects whether or not you buy the whole MMT story. I take a guy like Steve Keen, who's an absolutely brilliant economist. I'm sure he could make a very credible sounding argument for why MMT really could work and it could solve these problems and we wouldn't have the issues with healthcare. And frankly, I think that I know that I'm biased by my views. I don't believe in handouts. I think that Steve's own description of himself as a very left-leaning guy, in my opinion, explains a bit of why he is such a believer in MMT. I certainly don't know that he would say that, but that's my impression. So I think it does affect all of us.
Fair point. I'll take that.
And that concludes part 1 of our 2-part summer special. Today's episode was made possible by Top Traders Unplugged. Don't forget to go to toptradersunplugged.com/macro to claim your free copy of The Many Flavors of Trend Following and subscribe to their podcast as well. You'll be glad you did. For information on sponsoring Macro Voices, please visit macrovoices.com/sponsor info. Be sure to tune in next week on August 29th for part 2 in this 2-part series. Until then, for the Macro Voices Podcast Network, I'm Erik Townsend.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Erik Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.